Welcome back. Well, the big global development has been the US Fed, which has hiked rates by 75 basis points for the third consecutive time. Prashant is here. He's standing by with the 10 key takeaways from the FOMC meet overnight. Prashant.
Well, thanks very much for that. So the big event is out of the way with largely hawkish implications. Let's get to it then, right? And I'll break this down in 10 points. So number one, the Fed has delivered a third consecutive 75 basis point rate hike, which is in line with market expectations and consistent with recent Fed communication as well. Number two, while there were no major changes to the statement, the summary of economic projections showed a sharp increase higher in the federal Fed funds rate. These are projections of what the Fed sees its own Fed funds rate will be by the end of the year, by the end of next year, and so on and so forth. Number three, the median for 2022 in terms of these rate projections was taken for the end of this year from 3.375, that is 3.4, to 4.4% nearly. What this implies is important. Consider this. This implies that the median participant in the FOMC committee is looking for another 125 basis points of hikes in the remaining two meetings of this year, that is November and December. That is significantly higher. Number four, the 2023 dot, which is next year, went from, these are, again, I'm saying projections for where the Fed sees its own Fed funds rate at. It went from 3.75% so far to new estimate of 4.625%. This implies another two hikes next year beyond what they expect the Fed to deliver by the end of this year. On top of that, the 2024 and 2025 rate projections show modest gradual normalization. They expect rates to come down to about 3.875 and 2.875 as well. But even these rates are in the restrictive zone. We're talking about 24-25. Number five, Fed Chair Powell's first answer to the question in the press conference was prefaced by him with this comment. But even before he took the question and began answering, he said, "The main message for me has not changed at all since Jackson Hole," end of quote. So he wanted to make sure that there is absolutely no confusion what the focus for the Fed is, which is fighting inflation and bringing it down to 2%. Number six, these are economic forecasts now. Just like there are rate projections, there are economic projections as well. They were also revised, but mostly in a more pessimistic fashion. Why? Number seven, unemployment rate projection for 2023 and 2024 is now expected at 4.4%. This is an upward revision of about 0.5% and 0.3% respectively. The other projection is the growth projection for 2023, which was revised down, while inflation projection was revised higher. So it's the opposite of what you would want to see. Growth is being revised lower, inflation is being projected higher, and rate forecasts are moving up as well. Number nine, Powell in his prepared remarks, this is the statement which he reads off before he takes questions, highlighted that the restrictive stance of the policy is likely for some time and that history cautions strongly against prematurely loosening policy. This was the one big notable change from his July policy statement. Otherwise, there wasn't very, and this change is relatively at the margin hawkish. And last point, number 10, in the press conference in response to a question as to what will cause the Fed to slow or pause these rate hikes, right? Powell outlined three conditions: below trend growth, softening in labor market, and a clear evidence that inflation is moving to 2%. I mean, to summarize, I would say that this Fed meeting outcome has managed to surprise even the raised bar of hawkishness. The street and the market will have to play catch up with the Fed. Back to you.
Oh, absolutely, and that's what's taking place right now. Most markets are under pressure, including our own, which is at the lowest point of trade. Let's slip into a quick break. On the other side, Sudeep Shah of SBI Securities will be joining in. He'll have some trading strategies to share with us. Do stay tuned in.